It's not part of the government. It doesn't print your money. It can't set a single price in the economy. And yet, with one number, it steers $32 trillion of economic activity. Open the panel. Before we touch a dial, we need to understand what we are looking at. The Federal Reserve was created in 1913, after decades of banking panics had made one thing clear. The United States needed a lender of last resort. Congress passed the Federal Reserve Act, and the result was something deliberately ambiguous. Not quite a government agency, not quite a private institution. Here's the structure. At the top, the Board of Governors, 7 members, based in Washington, D.C., appointed by the President, confirmed by the Senate. That sounds governmental, but they're not a cabinet department. They don't answer to the Treasury. They serve staggered 14-year terms specifically so they can outlast political cycles. Beneath the board, 12 regional reserve banks, from New York to San Francisco, technically owned by the member banks in each district, private in structure, public in purpose. These two halves meet in the Federal Open Market Committee, the FOMC. 12 voting members, all 7 governors, plus 5 of the 12 regional presidents on a rotating basis. New York always votes. This is where policy is actually made. Congress gave that committee 2 instructions: maximum employment and stable prices, specifically 2% inflation, measured by the Personal Consumption Expenditures Index. 2 goals, 1 institution, a permanent structural tension between them. And there's a third ingredient, one that doesn't appear in the charter but underlies everything the panel can actually do. We'll come back to it. The first dial, the one that moves markets, the federal funds rate. At its core, the overnight rate banks charge each other when they lend reserves. Every night some banks have more reserves than they need, others have less. They lend between themselves at a rate that floats in a narrow band, a band the Fed targets. Right now, the target range is 3.5 to 3.75%. But here's what the old textbook gets wrong. The Fed doesn't control that rate by making reserves scarce, buying and selling just enough Treasury bonds to push the needle where it wants. That was the pre-2008 method. After the financial crisis, the banking system became flooded with reserves. Scarcity stopped working as a control mechanism. Instead, the Fed now uses administered rates, specifically interest on reserve balances, the rate it pays banks on reserves they park at the Fed overnight. No bank will lend to another bank at less than it can earn from the Fed risk-free. That becomes the floor. On the other side, the overnight reverse repo facility pulls in excess cash from money market funds, anchoring the lower bound. These 2 rates create the corridor. The actual federal funds rate floats within it, not because the Fed commands it, but because no bank has a reason to move outside the boundaries. That's already a pattern worth noting. The Fed moves markets not through force, but through where it sets the anchor. What does the rate actually touch? Not your mortgage directly. Not your car loan. Think of it as the base of the water table. Every loan in the economy floats on top of it. When that base rises, borrowing gets more expensive across the system. Investment slows, hiring slows, spending cools. When it falls, the opposite, 1 dial. Enormous reach. But what happens when the first dial can't go lower? That was the problem in 2008 and again in 2020. Interest rates hit 0. The conventional lever bottomed out, so the Fed reached for a second dial, the balance sheet, quantitative easing. The Fed creates digital bank reserves, entries in a ledger, and uses them to purchase assets in the open market, chiefly U.S. Treasury bonds and mortgage-backed securities. By taking those assets off the market and replacing them with reserves, the Fed pushes long-term interest rates down and floods the banking system with liquidity. The balance sheet peaked at roughly $8.9 trillion in 2022. Think about the scale, nearly $9 trillion of bonds and mortgage securities on the Fed's books. Since then, the process has reversed. Quantitative tightening, letting bonds mature without reinvesting the proceeds, has gradually drained reserves from the system. By 2026, the balance sheet has shrunk to roughly $6.7 trillion. This is the closest the Fed gets to printing money, but it is not printing, not in the physical sense. Physical cash is printed by the Treasury's Bureau of Engraving and Printing. What the Fed creates is digital bank reserves, entries in accounts held at the Fed. Those reserves live inside the banking system. They don't automatically become spending power in the broader economy. The valve is open. where the water flows depends on whether banks lend, businesses borrow, and households spend. The second dial extends the Fed's reach when the first bottoms out, but it too has limits. So how does turning either dial actually move a $32 trillion economy? Through the transmission mechanism, and it operates the way Milton Friedman described, with long and variable lags, roughly 12 to 18 months before a rate change fully works its way through the economy. The path: rates rise, credit becomes more expensive, businesses borrow less to expand, households borrow less for homes and cars, demand cools across the economy, and with lower demand, firms have less pricing power, inflation falls. None of that happens the week after the FOMC votes. Each link in the chain involves millions of individual decisions on their own timelines. The Fed raises rates today and feels the full effect a year and a half from now. It is steering a supertanker by watching the wake behind it, which is why the tool is blunt. The rate moves everything, sound investments and speculative ones alike, businesses that need capital to grow and those that probably shouldn't be growing. There is no surgical setting. The dual mandate sounds balanced. In practice, fighting inflation means raising rates, slowing the economy, and putting jobs at risk. Protecting employment can mean keeping rates lower than strict price stability demands. That tension is permanent. No rate simultaneously maximizes both mandates. Every FOMC meeting is a negotiation between them. And then there's the political dimension. The Fed is designed to be insulated from short-term political pressure, because elected officials have every incentive to want cheap money, especially before elections. But independence rests on institutional norms, not absolute law. In 2025 and 2026, that independence has faced open pressure, public demands for faster rate cuts, contested appointments, and explicit challenges to the institution's autonomy. This is not new in kind. Central banks have always faced political friction. What's at stake is whether the institution's credibility survives. Now here's the hard limit that makes credibility everything. The Fed cannot create goods. It cannot fix a supply shock, an oil embargo, a shipping disruption, a drought. It can only adjust demand. Fighting supply-driven inflation with rate hikes means pressing the side of the equation you can reach, hoping it offsets the side you can't touch. It cannot force banks to lend. It can provide reserves. It cannot compel credit. What it can do with full force is shape expectations. When workers, businesses, and markets believe inflation will hold at 2%, they behave accordingly. Workers don't demand inflation-adjusted wages preemptively. Businesses don't raise prices in anticipation. The self-fulfilling cycle never starts. The moment that belief cracks, the moment expectations become unanchored, the Fed must work much harder and cause much more economic pain to bring them back. That is what makes credibility the real lever, not the rate itself. The belief in the rate. Close the panel. Look at what we've built. One institution, a hybrid of public and private, independent but not sovereign, with two dials. The first, a target range for overnight lending rates, currently 3.5 to 3.75%, maintained through administered rates that bound the corridor. The second, a balance sheet of $6.7 trillion that can expand through quantitative easing when the first dial bottoms out, and contract through quantitative tightening when conditions allow. Both dials move a $32 trillion economy only indirectly, through the banking system, through millions of credit decisions, with lags of 12 to 18 months. Bluntly, imprecisely, the Fed cannot print your cash, cannot set your mortgage rate, cannot fix a supply chain, cannot run fiscal policy. What it can do is anchor the one thing that makes all of that work: the expectation of 2% inflation. That's the third ingredient we flagged at the start. Credibility is the lever. The dials are how they maintain it. And notice where this machine connects, directly into the banking system from the last video, the dollar machine. The Fed speaks to banks, banks speak to the economy. Reserves travel through that plumbing. One rate, every loan on earth. If this changed how you see it, there's a whole machine to explore. Follow along.